Okay, class, good evening.
Good
So
evening,
you're
sir.
welcome to another financial reporting class. Tonight, we are going to be moving to a new topic, but last week, we started with an overview of our syllabus, and also we looked at regulatory framework. And looking at the overview, we already have a plan on how we want to complete this syllabus for financial reporting. And also, I made you understand that when it comes to financial reporting, what ICAN needs you to know before you go and write that exam is your ability to prepare and present financial statements. You must be able to do that very well. And also, we expect that you should be able to analyze and interpret financial statements. So majorly, that's what the syllabus entails. Started with regulatory framework. And for regulatory framework, if you remember, I looked at it from two angles. First, I looked at the regulation itself, which are the rules and principles that governs reporting. And I also looked at the regulatory bodies, if you remember that. For the rules and principles, we said those are called GAAP. And in Nigeria, we have three sources of GAAP: the company law, the accounting standard, and the local stock exchange listing requirements. I told you that the accounting standard we use in Nigeria is the IFRS or the IAS. They have, like in the US, they use financial accounting standards in the US. The company law we use in Nigeria, we have CAMA, the Companies and Allied Matters Act. We have BOFIA, we have the tax law. They are also source of GAAP as well, and the local stock exchange listing requirement. But basically, I made mention that the IFRS that we use in Nigeria, which is the accounting standard we use in Nigeria, that it is principle-based. It's principles. They are pure principles. But the company law, rule-based. They are rules. The local stock exchange listing requirements, rule-based. So from there, we could conclude that in Nigeria, we use a mix of rule-based and principle-based framework. It's a mixture. If we want to look at just the IFRS alone, we will say, okay, that's a principle-based framework. But the IFRS is not the only source of GAAP. There are three of them, as you have seen. So our regulatory framework in Nigeria is a mix of rule-based and principle-based. And I remember we distinguished between rules and principles the last class. And I gave you an assignment asking you to research into advantages and disadvantages of principle and rule-based. You have it here in your notes. Then we looked at the regulatory bodies. In Nigeria, the body in charge of reporting IFRS, compliance with IFRS in Nigeria is the Financial Reporting Council of Nigeria. Your examiner expects that you know at least 7 objectives here. And I told you that the key objective of this body is to protect the interests of investors and other stakeholders. That's the key objective of this body. And all the other objectives are working towards meeting this first objective. They are working towards meeting. That being said, it's the duty of accountants to ensure that the FRCN meets its objective. And you must work towards it. If they don't, it could be an ethical issue for us accountants or for companies, as the case may be. So for example, all accountants are expected to be registered with FRCN and have an FRCN number. That before you can sign a financial report, you need to have an FRCN number. So if you sign an audited report without an FRCN number, it's an ethical issue. Or you even allow a professional, whether a lawyer, whether a valuer, whether an actuary, you allow them or you use their figures in your report. It's an ethical issue. And these guys go for regular audits. If you don't allow them access into your entity, it's an ethical issue. Or you don't even comply with the standard itself, it's an ethical issue. So when we do all of this, we are helping the FRCN achieve their objective. So take note of those ethical issues. I made mention that the FRCN are not the one that developed IFRS. There is a body or a structure that develops it. We call them the IFRS foundation structure. And this IFRS foundation structure is a three-tier structure because there are three levels of leadership. There is the monitoring board, who consists of they majorly consist of public market authorities, and they appoint the trustees of the IFRS Foundation. These trustees of IFRS Foundation, I told you that they are the engine of this structure because they are the one that have the mission or the objective of developing IFRS. So the IFRS Foundation trustee then delegates most of the objective to the IASB and the ISSB. I've seen a question in the exam where the examiner was asking you the objective of IASB. You see, the objective of the IASB is exactly the objective of the IFRS Foundation, as well as the ISSB as well. So we looked at this structure in class last week, and also we ended the class by looking at how IFRS is developed, setting of international accounting standards. I told you that the way IFRS is developed is an inclusive, a transparent due process, is open. So they ensure that people with the best thinking worldwide are involved. People, the most intelligent people are involved. So they make it open to everybody to participate. And the steps involved in developing the standards, I told you that there's agenda consultation where they develop a work plan. I told you that, yeah, they would conduct a research, and the research report is the discussion paper, which they will send out to the public for comments and opinion. Then ultimately they will decide that, okay, let's set these standards, which they will proceed to having a proposal for a new standard, which they will call an exposure draft, which they will send out for public comments and opinions. Ultimately, they will refine that exposure draft, then it becomes a new accounting standard or an amendment to an accounting standard. Then the step 4 is the maintenance program, where they carry out post-implementation review to ensure that people can actually use this standard properly and they can also apply. And basically, that was where we stopped. And I can remember I gave you this need for regulation, which I also said you should read up. I called it the reasons why regulation is necessary in Nigeria. And I hope you have actually looked at that. And by so doing, we ended with the first topic of this class. I've shared you the notes. These notes, you have it. I've shared you the recordings of this class. You have all the materials with you. I'm sure you have read it and you have looked through them. Today, we are moving to chapter 2 of your class and of your syllabus, which is the conceptual framework. Now, remember that I told you that IFRS is principle-based, is principles. Therefore, the IFRS itself must also be developed from set of principles. IFRS is principle based. So the principle that is used or that guides the development of this IFRS is what we call the conceptual framework. So the conceptual framework are the set of principles and guidelines that underpins the preparation and presentation of financial statements. So we can say that the conceptual framework are the principles that underpin the IFRS itself. So this conceptual framework we are looking at tonight are majorly set of principles that guide the development of the IFRS. So the conceptual framework majorly provides the basis for developing IFRS, for developing new standards. And also, they also help in amending existing one. Some people say that this conceptual framework is like the foundation of reporting itself. They say it's like the frame of reference for reporting because it is this framework that they use to develop IFRS. The principles that are used to develop IFRS is this conceptual framework. So it's the foundation of everything. Your thoughtful understanding of this conceptual framework would ultimately help you understand the direction of all IFRS. So when I'm teaching you the IFRS one by one, it will make sense to you because all of them are they are sitting on the set of principles we want to talk about today. From here, we can come up with some advantages of the conceptual framework. And the very first is standardization. With a conceptual framework, which is a set of principles that we use to develop IFRS, then that means developing IFRS becomes standardized and coherent. And you will now have a situation whereby each of those IFRS would have similar structure, will be similar from a structural perspective because they are developed from the same principle. I mean, you will see. So one of the topics that I will teach you that will take me a lot of time is IS 16 on PPE. And why I will take a lot of time there is that immediately you understand IS 16, all other standard relating to non-financial assets or non-monetary asset becomes easy for you because you will see that they are all the same. The same. The same principle in IS 16 will apply all across. And that is happening because these standards, these IFRS, are developed from the same set of principles, which is the conceptual framework. So one of the advantage of this conceptual framework is that it makes the development process of accounting standard standardized and coherent. Another one is that development of accounting standard will not be subject to political interference. So politicians cannot come and say that we want, or they cannot go and meet FLCN and say, let all companies measure their PP at fair value. They cannot say that. It's not possible because we have principles on which this development of IFRS are based. So political interference will not work because of conceptual framework. Another one is users and preparers of financial statements would understand that financial reporting or accounting practices are based on common ideology. And the common ideology here is the conceptual framework. So because we have the same set of principles, so users and preparers understand that reporting is based on a common ideology. And of course, it will provide guidance for unusual transactions. So it is possible that there might be transactions that we have not seen before, transactions that are new, transactions that there is no IFRS for it. If we have such transactions, then the conceptual framework will come in handy and helpful because it will help to treat such transactions because that's the principles where IFRS are developed from. So it can help treat any transaction in which we don't have an existing IFRS for. And some of the disadvantages of this conceptual framework is the fact that financial statement is for variety of users, and these users have variety of needs. So is it possible that a set of principles will meet the needs of all users? Is it possible? Considering the fact that IFRS is used by many countries, there are some countries that their economic environment is peculiar, like in Nigeria now. Right now, we are majorly focused on oil and gas to a large extent. So can a set of principles take care of that our peculiarity, right? Is it possible? And there are some other countries that have also specific peculiarity like that. Can it take care of their needs? Can it? So that can be a drawback for the conceptual framework. And also is the fact that the conceptual framework might not make the task of preparing and implementing IFRS any easier. For the fact that we now have a set of principles on which these standards are developed, that means there will be a lot of tasks that must be carried out at every point in time. So it might not make developing or implementing standard easier. Another issue you need to know is what is this conceptual framework actually used for, the purpose of it. And in identifying the usage of the conceptual framework it will be easy for you if you can identify those that use it. And the very first that comes to mind is the IASB. The IASB will majorly use this conceptual framework to develop standards. And also, they will use it to amend existing standards. Additionally, the IASB can also use this conceptual framework in promoting harmonization of international regulations. Remember, one of the objectives of the IASB is to harmonize international and national accounting regulation. So the way the conceptual framework can help is if they see that a country is not using IFRS or is not willing to use IFRS, then they can advise the country that they should use the conceptual framework to develop their standards. So if they use conceptual framework to develop their standards, then we would have a similar standard to that type of nation. It's possible for us to then have a similar standard. So it can help in harmonization. It can also help national standard setting body to develop their national standards. It can help preparers in applying IFRS to prepare their financial statements. And also, it can also help preparers to develop consistent accounting policies for transactions or other events when no standard applies. You see, for this point, one of the topics I will teach you very soon is accounting policies under IAS 8. So every company is expected to have an accounting policy. So if a company has an accounting policy, it means that every item in the financial statement will have a policy. And a policy or an accounting policy is how a company chooses to apply IFRS. Remember, the IFRS is principle-based. And principle-based means that we allow you judgment, we allow you choice, we allow you flexibility. That your judgment, that your choice is your own accounting policy. So you'll find out that different companies will then have different accounting policy. But of course, your accounting policy must be developed within the confine of the IFRS. What happens if you need to develop a policy for an item that we don't have an IFRS for, or there is no IFRS on it, how do you then develop a policy on such an item? That is where the conceptual framework can also come in handy. It can help companies, preparers, management of companies develop consistent accounting policy for such transaction. Also, can help users like investors, lenders. It can help them to interpret the financial statements. Can also help auditors. Can help auditors to form an opinion on the financial statements. And it can also help anybody that wants to understand how the IASB develops standard. Can help them understand the approach that the IASB used to develop their standards. And finally, it can help the IFRS Interpretation Committee to develop interpretations on new transactions on IFRS. So these are the purpose or the uses of the IFRS conceptual framework. Note that even though the conceptual framework is used in developing accounting standard, we don't expect that it conflicts. But if it happens that there is a conflict between the IFRS and the conceptual framework, is the IFRS or that particular standard dealing with that item that will override. I will repeat that. We don't expect that there should be a conflict between the conceptual framework, which are the set of principles used in developing IFRS. We do not expect any conflict. But should it happen that there is a conflict of treatment between the IFRS and the conceptual framework, then if that should happen for whatever reason, then we'd expect that the IFRS should override. So I can't really give you an example of such conflict because we have not really seen one. If not, I will have given you uh, such an example. But if it happens in the future, always remember that is the specific requirement of that standard that that will surely override. Okay, let me see if I can. Okay, let me see if you can understand this. So there's a standard called IS 23, borrowing costs. So borrowing cost deals with interest you pay on borrowing. So IS 23 requires that interest you pay on borrowing should be capitalized. When you hear that initially, you should wonder that, okay, why should interest be capitalized? When I say capitalized, I mean that it should be added to the costs of the assets. I mean, for now. So that's the requirement of that standard. But coming to the conceptual framework, conceptual framework will say that interest is an expense, that it doesn't meet the definition of an asset. So there's a conflict. So we will treat it in line with IS 23. You understand all of these principles as we move forward, but what is ultimate right now is that you should ensure that if you are asked in the exam, remember that is the requirement of the IFRS that will definitely supersede or override. Okay, so whenever I'm doing virtual classes, I usually put in quizzes just to be sure that you are following me. And I've just decided to start putting on my video so that you can see who is speaking to you. So let's look at some set of quizzes. Number one, which of the following best describes a conceptual framework? A, statement of gap. B, accounting concepts. C, accounting principles. D, basis of accounting. What's the answer?
Accounting principles.
Accounting principles. Okay, that's a good
Statement
trial.
of, statement
Any
of
other
gap.
statement of gap? Any other trial?
Accounting principles.
Accounting principles. Any other trial?
Accounting
I need
principles.
Okay, I need one more person.
Accounting principles.
Accounting principles. Okay, so here now, the answer is statement of gap. Yeah, so it's a very close one. So the conceptual framework is beyond accounting principles, even though they are set of principles, but not just accounting principles alone, other principles. So what captures conceptual framework is gap itself, because gap consists of the IFRS and some other regulatory requirements. So this is more encompassing than just accounting principles. So conceptual framework are a set of principles that guides the preparation of reporting framework. So limiting it to just accounting principles might be a little misleading, but probably maybe if they have said reporting, but we don't want to restrict it to just accounting principles. So that was a close one. The answer is statement of gap. And I think in the definition given by these guys, okay, it's not even there. They just said it's a set of principles like that. Okay, so that's that. Let's go to the second one. Where there is a conflict between an accounting standard and a conceptual framework, which one will override?
Conceptual framework.
Okay, conceptual framework will override. Any other opinion?
Accounting standard.
Yeah,
Accounting standard.
yes, that's the answer. The answer is accounting standard, not conceptual framework. And I mentioned that last. That was the last thing I mentioned. And it's written here, seven in red. Keep in mind that this conceptual framework is not an accounting standard itself, and it doesn't override the requirement of any existing standards. Okay, number three, the conceptual framework can help in the treatment of unusual transactions. True or false? True or false?
True.
True, yes.
True.
Correct. Correct. Number four, which of the following is not a purpose of the ISB framework? Which of the following is not a purpose? As assist ISB in preparing and reviewing,
True.
assist auditors in forming opinion, assist in determining treatment of items not covered by an existing, to be authoritative where a specific IFRS conflicts with the conceptual framework. Which of the following is not a purpose? The answer
I
is
suppose it's
D.
D. Yeah,
Yes.
to be authoritative. Yeah.
Yes. It's this one that is not a purpose. Okay, good. That means you are following. Fantastic. Okay. Now let's move to those set of principles. So this conceptual framework we are learning is the 2018 conceptual framework, replacing that of 2010. So this 2018 conceptual framework came with a lot of revisions. You revised some definitions. It brought in new guidance on recognition and the recognition of these elements. Also, new guidance on measurements, and it brought in principles of disclosure and presentation. So it's new. So the 2018 conceptual framework are organized into chapters. So, and these chapters are the set of principles we are speaking about. So chapter one talks about the objective of general purpose financial reporting. Chapter two talks about qualitative characteristics of useful financial information. Chapter three talks about financial statement and the reporting entity. Chapter four talks about the elements of financial statements. Chapter five talks about recognition and derecognition. Chapter six talks about measurements. Chapter seven talks about presentation and disclosure. Chapter eight talks about concept of capital and capital maintenance. Okay, so these are the 8 chapters we are going to run through tonight. As soon as we're done with this, then that means we have met our targets for tonight. So let's start with the first set of principles, which is called the chapter 1. And that deals with the objective of general purpose financial reporting. So when I was teaching this at VI, one of my students asked me, okay, what does it mean? What does general purpose mean? So I told him that it means that a lot of students, I say a lot of students, it means that these financial reports are used by many users. That's why it's a general purpose. So it's a single report that's for many people and for many needs. However, looking at the chapter 1, why is financial reporting prepared? This conceptual framework says that is to provide financial information. Look at it here. Provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. Okay, so you're expected to know this for your exam. For you guys, you should, the examiner can ask you, now, according to chapter 1 of the conceptual framework, what is the objective of financial reporting? You should be able to know this. So if not that I'm teaching you guys virtually, all of these things, word for word, I would regurgitate everything, word for everything. So you are also expected to be able to do that for your exam. So looking at this objective to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. So what does this mean? So he said to provide financial information. What financial information are we providing to users? So if I ask some of you, you might be telling me that this financial information we are providing to users, they are statement of profit or loss, statement of financial position, statement of whatever. No, those are not the financial information. That is just the form in which the information is communicated to users. The financial information, according to this according to this conceptual framework, they are, number one, this is economic resources of the entity, which is assets, the asset of the company, claims against the entity, which is liability, and changes in the entity's economic resources and claims, which are income and expenses. So when we say the objective of financial reports is to provide financial information, they know that that financial information we are speaking to, we are talking about the economic resources of the entity, the claims against the entity, and changes in the economic resources and claims. Now, you see, this financial information that is provided to users, this financial information are provided on an accrual basis of accounting. They are provided on an accrual basis of accounting. And what do we mean by accrual basis of accounting? When I ask my students, if I should ask you, a lot of you would know that accrual basis of accounting means that you recognize income where they are earned and not when they are received. You recognize expenses when they are incurred and not where they are paid. I mean, I will tell you that, yes, you're right, but that's more of elementary. The way the conceptual framework wants you to explain accrual basis of accounting is that you should recognize the effect of transactions and other events on reporting entities' economic resources and claim in the period in which they occur. So accrual base of accounting is saying that recognize assets, recognize liability, recognize income, recognize expenses when they occur. when the transactions occur, not when cash is received. So as soon as the transaction is consummated on an asset, for example, recognize it in your books. For a liability, recognize it in your books. For income, recognize it in your books. So that is the whole idea. Then I further explained it in a way to buttress how you used to know it before. But generally, accrual basis of accounting is how we present financial information. And you would see that as we proceed in learning these IFRS, you will see that all of these IFRS have been developed based on accrual basis of accounting, all of them, every one of them. That as soon as a transaction occurs, you recognize it in your books immediately. Just is the economic impact you want to see. What is happening? Okay, back to the objective. You said to provide financial information. And we have looked at the financial information that we actually provide. And also, we have looked at how they are presented, how they are provided, which is on accrual basis. It says that this information would be about an entity. I will look deeply into what an entity is very soon. So this information must be useful to existing and potential investors, lenders, and other creditors in making decision about providing resources. Okay. So this objective specified these three sets of users. So that means they see these three sets of users as the primary users of financial report. They see them as the people or the users that the financial reports are meant for. That goes to show that every IFRS is developed with the mindset of these three sets of people. But are these the only users that we have? No. There are other users of reports, like the government, the employees, international community, tax authority, name them. There are a lot of them. But they focused on the investor, who are the shareholders, those that invest in your shares, the lenders, those that lend you money, the banks or other high net worth individuals that lend you money, other creditors, your suppliers. These are the people we see as the primary users. And why are they the primary user? It's because they are the providers of capital. They are the one that give their risk capital to you. Without these three sets of people, you cannot have a business. They are the one that actually own the business. They are the lifeline of your business, right? So you need to be able to articulate very well in the exam in case the examiner asks you who are the primary users of financial reports and their information need. So you need to know the need or the decision the investors want to make, right? And investor, majorly the decision they want to make, when you provide them information about your assets, liability, income, and expense, an investor will majorly decide whether he wants to buy more of your shares or whether he wants to sell your shares. That's his decision. Because from your reports, you will see whether you are profitable or not. You will see it there. You will see the income you are making. You will see the expense. I mean, so his decision would then be, should I buy more of these your shares or should I sell? If he's buying more, that means he's impressed. If he's selling, that means he wants out. He's not impressed with your performance, right? Also, investor will also wants to make decision about how they are going to vote during meetings, whether they should change management, whether they should change auditors. I mean, all depends on the information you give to them. Information you give to them about your liquidity, about your profitability would enable this their decision, right? The same thing as the lenders. You'll be making decision on whether they should give you more money or whether they should recover the one they have handed over to you before now. All depends on what they are seeing. If they are seeing your assets and they see that you are selling your assets, that means the money they gave to you is not secured, because they will see it there based on the notes that you put there that you're selling assets, because they want to be sure that the money they have given to you is secured. They want to see that in your asset that you are liquid. All of those will inform the decision on whether they should recover the existing money they've given to you. And also, in fact, they will make decision regarding the interest rates they will charge you, depending on how risky they see you. The suppliers will definitely make decision on whether they should give you more goods, whether they should even give you more credits. Yes, whether they should extend more credit to you, or whether they should even give you discounts to encourage you to come more, or whether they should stop selling to you on credit. All depends on the information you are giving to them. So those are the decisions this set of primary users want to make. And I kind of asked this before. They gave us this objective and they asked you to list and explain the primary users and their information need and the decision they want to make, like that in the exam. Okay, so that's the chapter one. That's the chapter one of the conceptual framework. So it talks about the objective of reports, the primary users, and what the decision they make with those information. Now, okay, I see some questions here. Okay, good. So let's see. He said the conceptual framework makes it clear that financial information should be prepared using cash accounting, accrual accounting, all of the above. That's the answer.
Accrual.
That's correct. Accrual
Accrual
accounting.
accounting.
Number two,
Accrual.
correct.
Accounting.
Yeah, all correct. Number two, which of the following is a financial information provided by an entity according to the conceptual framework?
Statement of financial position.
Okay, good idea.
Claims
Claims
against the
against the
entity.
entity.
Claims against the entity.
That's correct. That's the correct answer. Claims against the entity. That is the answer. Remember those three financial information: economic resources, claims against the entity, and changes in the economic resources and claims. So the only one that is there is the claims against the entity. Number three, which of the following is a user of financial information according to the conceptual framework? Government, lenders, employees, tax authority.
Lenders.
That's correct. Lenders. Correct. Okay, good. You're following. So, chapter two. Chapter two talks about the qualitative characteristics of useful financial information. Please very close attention to this chapter two. 90% of the cases, ICAN asks questions from chapter two. The remaining 10% of the case, they ask it in chapter one. So chapter one, chapter two are the major one. Not saying that they might not move to those other chapters, but in the past, they are the one that are bulky. Okay, let's look at it. So qualitative characteristics of useful financial information. So this is saying that there are certain attributes that a report or a financial information must possess for it to be an information. So the conceptual framework then distinguishes these qualities, these attributes, into fundamental and enhancing. So we have the fundamental characteristics and we have the enhancing characteristics. So you see, the fundamental, from the name fundamental, you see, you agree with me that these are very important attributes. And when an information possesses them, then it is useful. If financial information lacks these qualities, it is not useful or it is misleading. So the fundamental characteristics is what makes the reports or the information useful or not useful. while the enhancing simply makes it more useful or less useful. So that's why they call it enhancing. So a report can still lack enhancing. It will only be less useful. It doesn't mean it's not useful. But if it has it, it becomes more useful, right? So let's look at the fundamental. There are two fundamental characteristics. There are two of them. We have relevance. We have faithful representation. Relevance means that the information is capable of making a difference in the decision made by users. Capable of making a difference. And something is capable of making a difference if it has predictive value and confirmatory value. From the name predictive value, it means we can use it for predictions. Confirmatory value, it means it can confirm whatever prediction we have made in the past. Predictive value, confirmatory value. Then it is relevant. It can make a difference. It can help your decision to make a difference. So you see, relevance here is resting on materiality in the sense that when you look at financial reports, you see that there will be some figures that are small. Those figures, you will not even see them on the face of the reports. They will have aggregated it as part of some other items. So the items that can affect relevance are those items that are material. Those items that if you meet or misstate them, it's going to influence the decision users make on the basis of that information. So relevance of information is usually affected by its nature and materiality. So majorly, they are affected by the nature, the type of item we are talking about, and more importantly, the materiality of the item. Because an item that is not material is not even relevant. It won't affect relevance. So it is an item that is material that can affect relevance and also the nature of the type of item that we are actually speaking about in the financial report. So materiality is what's established or what relevance is resting on. So if I should ask you what is relevance or explain relevance, all of these things here are very important for you to remember to get 2 marks in the exam. So do well to remember them. Capable of making a difference, predictive and confirmatory value, and relevance is affected by material. Then the second one is faithful representation. So you see, a financial report in itself is an economic phenomena in words and number, meaning that it helps us describe our economic activities in words and number. So for a financial report to be useful, it must only represent the phenomena faithfully. It must faithfully present the phenomena that it purports to represent. Okay, so what this is saying is that if your economic phenomena is that you made 20 million in sales, don't say you made 25 million. So you must faithfully present the phenomena that it purports to represent. So if your sales is 20 million, then faithfully present it as 20 million, faithfully. So we are hoping that you will be faithful, right? But we know people will not be faithful. So we now said that then to be a faithful representation, for us to be sure that you are faithfully representing, and what you are presenting is what your economic phenomena represent, then we are saying that your information must be complete, it must be neutral, and it must be free from errors. A complete depiction or a complete information is that contains all the necessary information the user needs to understand the phenomena. It contains a description and explanation of all your economic activity. Everything is there. All of your transaction is there. Okay, so if you omit anything, it becomes a problem. That means your information is not useful. So you must give us a complete picture of your entity, everything. The one that you cannot describe and explain in figures, explain them in words, because a financial information is an economic phenomena in words and numbers. So explain them to us. Complete. Second one is neutral. When preparing your report, you should not be biased. Presentation of financial information must be without bias. You must not have a mindset. You should not present a report to say that you want to wow your investor. You want to wow your competitor. No, it is not your report that will wow them. It's your marketers, is your sales, is what you do on the field. Whatever you have done is what accountants report. It's not accountant that is wowing anybody. We report the economic phenomena, so we cannot be biased. So our reports must be neutral. It must be a neutral depiction. It should be without bias. And in explaining neutrality, it's explained with prudence. Prudence. And what prudence simply means is that be cautious when you're making judgments. We know IFRS is about judgment, but be cautious in such a way that you don't overstate or understate your assets, liabilities, income, and expenses. That's prudence. And all IFRS are also developed on this set of principles on prudence. You will see most of these IFRS, they ensure that you do not overstate your assets. And that is why, for example, I'll be teaching you the principle of depreciation. It's prudence. You will see that when you have an asset and you put it in your books as an asset at 50 million today, at the end of the year, we will say that it should now, the carrying amount should not be 50 million anymore. It should be like 45 million. You depreciate it, right? You allocate some of the costs because we believe you have started enjoying the benefit. It's prudence. So prudence will ensure that you don't overstate any of those elements, any of those information, right? That's prudence. So prudence ensure that you are not biased. It's make sure we are cautious when we are making judgments. It puts us in check. And number three is free from error. So yeah, free from error. When we say free from error, yeah, we are not speaking to accuracy of our figures. We are not speaking to the accuracy of our figures because we know that our figures cannot be accurate. We know because in reporting, we make use of estimates, we make use of judgments. I mean, so it's not accurate. So what is then free from error? Free from error is talking about you should ensure that there are no errors or omission in the description of your phenomena, of your economic activity. When you're describing in your report, when you're describing in the notes your performance and your position, don't make errors. Make sure they are complete. That's one, in your description. Number two is that don't make errors in the process by which the information was produced. Don't make errors. Like when you're doing your double entry, don't make errors there. When you're classifying a transaction into maybe assets or expense, like that, don't make errors. So in the process in which the information was produced, don't make errors. So free from error is speaking to the description of the economic phenomena and also the process in which the information is developed. And these three explains faithful representation. So if you want to get 2 marks in the exam, you need to mention complete, neutral, free from error, and explain them. and that gives you 2 marks. However, we have mentioned that reporting is based on estimates, judgments, models. So we know that these estimates can affect our faithful representation. So we always make provision for it in our report. We call it measurement uncertainty. I need at your level worry less about measurement uncertainty. But measurement uncertainty is just saying that yes, we acknowledge the fact that we make use of estimate and errors. And usually, um, when you check reports, you see that areas where we have made estimates and judgments, IS1 requires that entities must disclose those areas, right? Where you have made judgment and estimates. So as we move on in learning this IFRS, I'll be telling you areas where we make estimate and judgments, because IS1 requires that you disclose that so that we'll be able to know where the level of estimate is very high. So that means there's something we call measurement uncertainty. That means the level of measurement uncertainty is high. It can affect your faithful representation. It can affect it. It might not be free from error. So we usually disclose that because it can affect faithful representation. Another thing under faithful representation is substance over form. So substance over form is what ICAN can ask you to explain at your level. And they can also even ask you to present, they can give you a scenario and ask you to present or to prepare a report based on its substance and based on its form. So what does it mean? What does substance over form means? So the full representation of substance over form is actually economic substance over legal form. Economic substance over legal form. So there are 2 phrases here. One is economic substance, and the second is legal form. So when we say economic substance over legal form, it means that when we are preparing our reports, we prepare it in accordance with economic substance. We recognize financial information based on their economic substance and not their legal form. So what is economic substance? What is legal form? So economic substance is saying that when you have your report, your information should focus on the financial implication and economic impact of a transaction. That is, you should recognize just the economic and financial reality of the underlying transaction, the business reality. Whereas legal form is looking at the way transactions are structured or documented legally. Let me give you an example. Example where the economic substance and the legal form might not be the same. So economic substance is saying is really speaking to the economic and financial reality of a transaction. Legal form is talking about how transaction is legally documented and structured. So in most cases, let me make this clear first. In most cases, economic substance and legal form, you find out that they are the same. They are the same. But there are situations where they are different, like in a lease transaction. When you have a lease transaction, you find out that the legal form is different from the economic substance because there is the owner of the assets, who is the lessor, and there is now a tenant who is the one with the economic impact, who is the one using the assets to generate benefit. And as far as we are concerned, that's the substance. We focus on the economic substance now, because now there's a difference between substance and legal form. There's the tenant or the lessee who is the one using the asset now, and there is the landlord or the lessor who is the owner. So who recognizes the asset in his books is the tenant as far as reporting is concerned. It's the lessee that should recognize the asset in its books, even though it's not the owner. But we focus on the economic and financial reality. Who is making money from this asset? Who is using this asset? Accountants don't go about looking for documents, like legal documents, because if anybody don't tell us and we see somebody, we walk in, we see an asset and it's making money for you, and we want to account for that business, we will put that asset in your books. If you are telling us later that you are not the owner, you are not the owner, no, we will still value it and put it in your books, because that's the reality. It's making money for you. So whether you are the owner or not, does not matter. That's economic substance. That's the principle on which IFRS are developed and on which transactions will be recorded ultimately. You are going to learn this in IFRS 16. Another example is sales of assets. You see, ordinarily, when you sell an asset or when you sell goods, you should recognize that goods as, or that transaction as sales, as revenue. But when it happens that you sold to somebody, there's now an agreement to repurchase at a fixed price. You sold, you now tell the person that you buy it back at a fixed price. That becomes a problem, because for us, the reality is like you did not sell because you want to buy at a fixed price. If you were buying at the fair value, that is okay. If you're going to buy it back at fair value, that's fine, because that means, yes, you have really sold. The problem here is the fact that you want to buy back at a fixed price. Then there's a problem with whatever agreement you have, because that fixed price might not be the reality, because we focus on economic reality and we don't want guessing. We don't want to, we want the reality of the transaction. And saying you want to buy it back at a fixed price shows us that it's either you just give the person the assets, that hold it for me, I'll collect it back later. Or probably you needed money. You now give the asset as collateral. You just want to give the asset as collateral and collect money that you need. So when you pay back, collect back your asset. So when you have that type of transaction, then you cannot recognize sales. In fact, that money you collected from selling will be recognized as borrowings. That will be borrowings. So that's economic substance over legal form. We focus on economic reality. We focus on financial reality. We focus on the economic impact of a transaction and not just the legal form. And I told you that in most cases, you find out that the economic substance and legal form are the same. They should be the same. So when we have a situation where they are different, where they differ, then in such cases, we go with economic substance. Okay, so that's the fundamental characteristics. Now, for the enhancing characteristics, there are 4 enhancing characteristics. We have comparability, we have verifiability, we have timeliness, and we have understandability. So the first one, which is comparability, this is saying that we should be able to compare your financial statement with other entities' financial statements. Of course, you guys will be in the same industry, and we should also be able to compare your financial report with that of your previous period. Okay, so comparability. And you find out that in most of these IFRS, they focus on comparability a lot. They focus on ensuring that we are able to compare one financial report with another, and your financial report of previous year with that of the current year. So to achieve comparability, then we'll be talking about consistency of treatment of items, ensuring you disclose accounting policies, all of these helps to achieve that comparability characteristics. Another one is verifiability. And verifiability is saying that we need to be able to recheck or recalculate your figures. And the way we can do that is by ensuring that if you say in your statement of financial position that the value of your PPE is 40 million, for example, we should be able to understand how you derived that 40 million. There must be somewhere in the notes where you do a breakdown of that 40 million, where you explain each component critically. You explain the costs, you have child depreciation, that depreciation, which method of depreciation are you using? You would give us all the details so that somebody can be able to recheck and verify it. Timeliness. We should ensure that reports are delivered to the users when they need it, to investors when they need it, to regulators when they need it. If you're a listed entity, deliver your reports to SEC before the end of the first quarter of the year. If you are a company that want to file return with FIRS, deliver it before the end of 6 months after your reporting date. Deliver it on time. Then understandability is speaking to, it should be easy for users to interpret and understand. It should be simple. And when we say user, we are speaking to people with reasonable business and accounting knowledge and that have willingness to study the report. Those are the users we are referring to here. People with reasonable business and accounting knowledge and have the willingness. So if you say you're an investor and you don't have accounting knowledge, we don't expect the report to be understandable to you. So understandability is speaking to those set of users. Now, those are the qualitative characteristics, and there's something called cost constraints. Cost constraint is saying that in meeting these characteristics, so make sure the benefits of providing this information is more than the costs. So if the cost of providing this information would be higher than the benefit, it's better you your report doesn't need to have these qualities. It's not necessary for you to have it. Okay, so I've spoken for another few minutes. Let's look at some quizzes together. So quiz 1. Are you there? Number 1, comparability is identified as an enhancing qualitative characteristics in the ISB's Conceptual Framework for Financial Reporting. Which of the following does not improve comparability? Okay, this is a tough question. Restating the statement of previous years when there has been a change in accounting policy, prohibiting changes of accounting policies unless required by an IFRS or to give more relevant information, disclosing discontinued operation, applying an entity's current accounting policy to a transaction which has not engaged in before.
Disclosing discontinued operation in financial statements.
Okay, good idea.
I talk. I never knew my mic was on.
Yes. Any other idea? Okay, so the answer is D. The answer is D. Applying an entity's current accounting policy to a transaction which an entity has not engaged in before. So which of the following does not? This one will not improve comparability. So because this is a new transaction that we have not engaged in before. So is okay for you to use a new policy for that. But you see these other three, they definitely improve comparability. I've not actually taught you most of these things, so that's why I say it's a tough question. Like, I will still teach you discontinuing operations. The essence of discontinuing operations, according to IFRS 5, is to improve comparability. So it definitely improves comparability. So you will learn all of those as we move forward. So another one is faithful representation. They said faithful representation is a fundamental characteristics of useful information within the IASB Conceptual Framework for Financial Reporting. Yes. So now said, which of the following accounting treatment correctly applies the principle of faithful representation? A, reporting a transaction based on its legal status rather than its economic substance. No. You should know that this is a no. I already mentioned economic substance over legal form. Okay, that's faithful representation. Economic. So this one is saying legal form over economic substance. Never. So A is not the answer. This one does not apply faithful representation. Number two, excluding a subsidiary from consolidation because its activities are not compatible with those of the rest of the group is a no. You will learn in IAS 27 and IFRS 10 that you must include a subsidiary in the consolidated financial statement. You must include it. The only scenario where you are allowed to exclude a subsidiary is where the subsidiary has been disposed or has been sold. That's the situation where you would exclude a subsidiary, not saying they are not compatible. That will not work. So this one does not apply faithful representation because it doesn't comply with the standard completely. Number three, recording the whole of the net proceeds from the issue of a loan, which is potentially convertible to equity. So this one also, you will learn this one in IFRS 9, that when you have a convertible loan note, you need to bifurcate it into debt and equity. So by the time you are now recording the whole of the loan note as loan, is not faithfully representing. And definitely this one is the answer. Allocating part of sales proceeds to interest, even though it was sold with 0%. So you will learn later that when you sell on credit, right? When part of your consideration is there is a credit transaction, the credit is extended. So we assume that you have given that person loan, and you need to recognize part of the sales proceeds as interest. Okay, so these are advanced questions that you would only be able to attempt them when you understand most of these standards very well. But I mean, we are exposing you to them early on. Number three, say that financial statements represent transactions in words and numbers. That's correct. To be useful, financial information must faithfully represent this transaction in terms of how they are reported. To be useful, financial information must represent faithfully this transaction in terms of how they are reported. So which of the following accounting treatments would explain an example of faithful representation? So A, when you charge rental payment for an item of plant to the statement of profit or loss, where the rental agreement meets criteria for a finance lease, this is wrong. So when a rental agreement meets finance lease criteria, you don't recognize the rental as in P&L. You actually capitalize the whole of the rent payments and put it as right of use assets. So that's just by the way. So, or you put it, if you are the lessor, you put it as the lease receivable. You learn that in IFRS 16. Another one is including a convertible loan note in equity on the basis that the holders are likely to choose equity option or on conversion. This is also wrong. When you have a convertible loan note, you bifurcate it, you separate them into equity and debt, because we don't know which one the loan note holder will choose. So when you are now assuming that, okay, let's recognize this as equity, you are now, because you believe the holder will go for equity option, you will lend this one to in IFRS 9. So the recognizing factored trade receivables without recourse. Yeah, this is the correct answer. So this is faithfully representing, because when you have a factored receivable, meaning you sold your receivables and it's without recourse, it means that those people who you sold the receivables to, if they are unable to collect those money from the receivables, they cannot come back to you. So you can go ahead and recognize the receivables because you have sold it without recourse. You have factored it to another party without recourse. The party cannot come back to you that, we are unable to recover the receivables. So they might say they want to collect back their money. No. When you factor a receivable and the agreement is that it's without recourse, you can recognize that receivables. Definitely, this is not then if C is the answer, then D is not the answer. Treating redeemable preference shares as part of equity, that's very wrong. You will learn also in IFRS 9 that redeemable preference shares are debt instrument. Okay, so these are things you would have to understand. So by the time I've taught you these standards and you come back to this, you should be flowing. I'm flowing with them right now. Okay, now we are now back to the simple ones that I believe you should be able to attempt. So number 4, which of the following is not a fundamental characteristics identified in the conceptual framework? Faithful representation, relevance, materiality, reliability. What's the answer to this one?
Reliability. D.
Reliability. That's correct. That's correct. Number 5, in accordance with the ISB's, the conceptual framework for financial reporting, which qualitative assumes that users have reasonable knowledge of business and willingness to study the information with reasonable diligence. Which?
Understandability.
Thank you, Joseph. Perfectly correct. Perfectly correct. Okay, so the remaining chapters will be faster now. We have done the hard parts. These other ones are actually, when I taught my student at the physical class, most of them, I told them to go and read up this chapter 3 to chapter 8. They are very straightforward. So chapter 3 talks about financial statements and the reporting entity. So first, this chapter 3 talks about objective and scope of the financial statements, which we have already spoken about. That is to provide information about asset, liabilities, equity. So there's no need to repeat that. It's the same thing. Chapter 3 also talks about a reporting entity. So I said I was going to explain this here. So a reporting entity is an entity that is required or chooses to prepare financial statements. That's the first thing you need to understand as a reporting entity, because there are some entities that are required to, especially those listed companies, and any limited entity really is required to. Why some entities just choose to? It's not compulsory that like a sole proprietorship business, so they can choose to prepare, not because they are required to. And also, a reporting entity can be single entity, a portion of a single entity, or it can be more than one entity. Whatever it is, whether it's a single, and you know what a single entity is, like we, like Equity Professional Limited, we're a single entity. Okay, and we could have a portion of a single entity. Like us now, we have a branch at Isolo. We have one at VI. So the one at Isolo is a portion of our entity. We can see that as a reporting entity, even though it's a portion. Yeah. Also, it could be more than, I mean, this is a scenario where entities have subsidiaries. That's more than one entity. So we see them together as a single entity, right? So all of these are the ideology, all of these standards incorporated when developing how you treat transactions like that. So like there's a standard called IFRS 8 operating segment. That's the one that deals with reporting for a portion of an entity. And those of you online class in that attended our online class, Mr. Abiodun already started teaching you group accounts. So you will see that the whole idea is that presents the information of the parent and the subsidiary as if it is one entity. So we are seeing all of them as a reporting entity because the conceptual framework is saying that a reporting entity can be more than one entity. So all of them together can be one entity. So that's why any transaction between them, we cancel them out. Whether one invests in another, cancel it out. Whether one give loan to another, cancel it out. Whether there's a transaction between the two, cancel it out. I mean, report them as one entity. So, and finally, a reporting entity does not have to be a legal entity. So a reporting entity can be a sole proprietorship business, partnership business, a company. It doesn't have to be a legal entity, right? Chapter 3 also talks about reporting period, which is the period over which we prepare the information. And this period could also be a forward-looking, can provide forward-looking information and comparative information like that. So reporting period for us, we focus on this current period and giving comparative information for the previous year. And in the current year, we also encourage that you can give us forward-looking information, like giving us information on your discontinued operations, giving us information on your diluted EPS, giving us information on maybe some assets you plan to sell, non-current asset held for sale. Those are forward-looking information that you can give us in your current period. So that's reporting period. And when speaking about reporting entity, we should prepare financial statements from the perspective of the reporting entity, not from the perspective of investors or whatever. So chapter 3 talks about perspective adopted when preparing financial statements. So it is from the perspective of the entity. So this one is still talking about don't be biased, something like that. And it also talks about going concern assumption. I'll teach you this in the next class very well, but it's mentioned in the conceptual framework too, that we prepare our report on the assumption that the company will continue to operate into the foreseeable future, like that. So that's going concern assumption. So if a reporting entity has more than one entity, here chapter 3 is also talking about prepare a consolidated report. It's better you please consolidate it in line with IAS 27 and IFRS 10 and also IFRS 3. Yeah. So that's chapter 3. So immediately all of these points, reporting entity, reporting period, perspectives, prepare consolidated reports where you have more than one entity. So chapter 4 talks about the element of financial statements. So that is where it introduces, as far as financial statement is concerned, these are the elements. And if you remember in chapter 1, we talked about the financial information. You will see that these are also the financial information. So the only one that is coming in now is equity. So what chapter 4 does is to define it. So, and the way it defined it is a principled approach, right? Look at the way it defined asset, for example, now. It said asset is a present economic resource controlled by an entity as a result of past events. So And so a present economic resource. So what's an economic resource? Look at the second sentence. So an economic resource is a right that has the potential to produce economic benefits. What this is speaking to is that an economic resource is anything, a right, something you have a right on, and that thing produces economic benefit to you. Anything. Anything. It doesn't have to be something big, something gigantic. So if your idea of an asset is something serious, in fact, if you have a social media page, right, and it's making money for you, that is an economic resource. Just think of anything. Anything. I'm sure somebody is thinking that you are, if so that means my boyfriend can be an asset to me. No, we are not talking about human being here. Anything that you have right is a right that has the potential to produce economic benefit. That's the idea here. So an asset is a present economic resource. So you see the way this definition is going. We're not telling you that this must be an asset, that must be an asset. No, we're just giving you a guide, a principle. So if you have this in mind, you will know what an asset is. Understanding that, okay, anything that produces economic benefit is an economic resource, then that can be an asset. So just think of it, anything that produces economic benefit. So, and don't forget, I'm sure you understand what economic benefit be, whether inflow of money, of cash to you. That's economic benefit. Economic benefit can be if it's reducing your liability, if it's not making you spend money, if it's reducing your liability, if it's giving you savings, yeah, that's economic benefit, right? So thinking in that line, like that. So, and this economic resource, this thing that is making money for you, you must have control over it. So control is very important here. Control here means that that money is making for you is actually your own. It comes to you. It flows to you. So if that money flows to you, then you have an asset. That's what an asset is. And of course, you must have bought it. It's as a result of past events. So we don't want to say, I plan to get an economic resource that will generate benefits. That is not an asset, though. You are still planning. No, before we can say, okay, this is an asset that you put in your books, it must be as a result of past events. So students are supposed to know this definition by heart. Present economic resource controlled by an entity as a result of past events. An economic resource is a right that has the potential to produce economic benefit. Second is liability. So liability is a present obligation of the entity to transfer economic resource as a result of past events. So a present obligation. So the key word here is obligation. And when we say obligation, is a duty to act in a certain manner, a duty to act in a certain manner that you must, is something you have to do. And here, the conceptual framework emphasizes that this thing you have to do, this duty, you cannot avoid it. You have no practical ability to avoid. That's how the conceptual framework puts it. A duty in which you have no practical ability to avoid. That means if you can avoid it, then it is no longer an obligation. Then that means you don't have a liability. You cannot recognize such event as a liability. So a liability is a present obligation, something that you cannot, an obligation here is you cannot avoid. You will do it. You must. It's just like you have employees that they have worked for you. You cannot avoid it. You must. So, and you have not paid them, it becomes an obligation. It's a liability. And of course, that duty is to transfer economic resources, to transfer your assets as a result of past events, something that is generating benefit to you that you have to transfer. course, as a result of past event, it must have happened. We're not talking about you are still thinking of an obligation. No, as a result of past events, it's something that is already happening, right? So a liability is a present obligation of the entity to transfer economic resources. So this definition are so important because that's where everything, every transaction, you need to be able to apply this definition to them to know whether it is a liability or asset. So a liability is an obligation to transfer economic resource. And remember, this obligation, you cannot avoid it. Thirdly is equity. So equity is the residual interest in the asset of an entity after deducting all of its liabilities. So the key word here is residual interest. Residual interest in assets. So the question should be, who has interest in assets? Interest in assets is those people that will get returns from the assets. They have interest. That if the asset makes money, those benefits you get in the assets, who do you give it to? Those are the people that have interest in it. And they are possibly your investors or your lenders, those key users, those primary users. So out of that primary users that I mentioned, there are some of them that their interest is primary, their interest is preferential, right? Like the lenders, those ones, as soon as you are making money, you pay them interest. Like the suppliers, as soon as you are making money, you pay them back their money. Those ones are preferential. Those ones are not equity. So is the investor that, in fact, it's not even all investors whose interests are residual. Some investors, like there are some that their contract is that whatever it is, you must pay them dividend every year. Those ones are also preferential. So equity are those whose interests are residual, meaning after you have taken care of all stakeholders, then you come and take care of them. So when you have a contract with such an investor, and the contract is that it is after you have taken care of all stakeholders that you take care of them, then that is equity. So for us, we see the equity as the major risk stakeholders. We see them as the major risk takers. They are like the real owner of the company. They are the equity holders, right? So whoever that is, that's the equity. So usually we see equity as ordinary shares and the reserves that are due to them. Okay, those are the guys we usually put in as equity. So another one is income. So income is an increase in assets or decrease in liabilities that result in increase in equity. Let me not take the risk. Just give me 1 minute. I didn't know my battery is flat. Income is an increase in assets or decreases in liabilities that result in increase in equity other than those relating to contributions from holders of equity claim. So 3 things that income deals with says an increase in assets. Anything that increases your assets is an income. So like when you make sales now, sales would definitely increase your asset because cash will come in, right? So that is an income, sales. Or if you revalue your asset, for example, now, and the valuation of the asset goes up as a result of maybe inflation or whatever reason that makes the value go up, that is an income. So some people might think income and sales are the same. No, income is far bigger than sales. Income is just, I say, sales is just a portion of income. In fact, sales is just a portion of increase in asset. Increase in asset alone is bigger than sales, right? So income is that increase in your assets. Income is also decrease in your liability. When your liability decreases, that decrease is an income. So this decrease, remember, is not when you settle low. When you settle your liability, that one is not income because you are just paying back your liability. But when your liability decreases, not as a result of settlements, as a result of some other things, maybe the guy said don't pay again, or probably the value just decreased, or probably they gave you discount. Those are income, right? And also, increase in equity is an income too. But when we say equity, remember I told you equity is your investors, your share capital, your ordinary share capitals to be specific. So when it increases, it's an equity. But bear in mind that this increase in equity, we're not talking about additional share capital. We're not talking about additional capital. We're not talking about contributions from holders of equity claim. No, that's not the increase in equity we refer to here. Okay, because there are other items that can increase your equity beyond just contributions, beyond just additional capital. And another thing that can increase your equity is profits, gains. Okay, when you make profit, it increases your equity. Profit is an income as well. It's an element of income. Okay, so that is an income. And the reverse of income is expenses. So expense will be decrease in your assets. When your asset decreases, is an expense. Anything that decreases your assets, whether it's depreciation, whether it's allowance for receivables, whether it's impairments, anything that decreases your assets is an expense. Or anything that increases your liability is an expense. And it will result in a decrease in equity. And this decrease in equity here, we're not talking about distributions to holders of equity claim. We're not talking about dividend, right? Dividend is not an expense. When you pay dividend, it's not an expense. It's a share of profit. The decrease in equity that is an expense here is losses. The decrease in equity here are losses, okay? And that is chapter 4. The elements of financial report. All of this breakdown of my explanation, I've actually explained everything here, like economic benefits that I explained. I have everything. Those obligations that I defined, everything. I've explained everything here to you in details. The income, everything I explained. So everything I've mentioned, I explained everything for you guys already. So let's look at some quizzes again. Quiz 1. It says, in accordance with ISB's Conceptual Framework for Financial Reporting, what is the definition of income? Okay, this one is very straightforward. The answer is C. Increase in assets, decrease in liability, increase in equity. C, other than relating to contributions. The answer is C. Number 2, Rena PLC has purchased a patent for 20,000. The patent gives the company sole use of a particular manufacturing process, which will save 3,000 for the next 5 years. What element of financial statement is the patent? Can you try this one?
Asset.
An asset.
An asset, sir.
That is correct, sir. Next one. Ade Limited paid Wisebaba PLC 10,000 to set up a car repair shop on condition that priority treatment is given to cars from Ade Limited fleet. What element of financial statement is this 10,000 to Ade?
A liability.
Liability, okay. Good attempt.
Expenses.
Expense. I need one more person.
Okay,
People are trying.
it's an expense. Sorry, it's to Ade, 10,000 to Ade. I thought it's the other person.
Okay.
Okay.
It's an expense.
Okay. Expense. Expense.
Expense. Okay.
Not
So
equity.
equity. Yeah. So she's the person that said equity. I'm sure she's looking at it as if Ade has invested in
Yes. Stop it,
Baba.
money.
Abi,
Yeah.
it's very rational. So I'm really interested. Those that were because almost before she said that is it equity because he paid to set up Abi. So those that said are expense. Why did you say expense?
When you see the paid,
Pay to set up car repair
that
shop.
paid it
It
makes
was
it
more
feel.
like
But
it
when you
was
make it to the
investing.
next expense,
There was an outflow, so you paid an expense.
Yes. So if you want to invest in somebody now, because when we say equity too, there will be an outflow now. Assets too, there will be an outflow. All of those things. Assets, you pay money to buy it. Equity, you pay money to invest, right? So as far as our day is concerned, as far as our day is concerned, it is not an asset to our day. Me, I was even thinking, in fact, let me speak from the direction of what your answer was. Let me start with the person that said equity. So, as far as Ade is concerned, it is not an equity because Ade is not expecting shares from Wese Baba. It is not like he's expecting, it's not an interest in assets. Equity is a residual interest in assets. He's not expecting any return from Wese Baba. In fact, the only thing he's expecting from him is priority treatment is given to the cars from Ade Limited, right? On condition that priority treatment is given to cars. So for us, that will not see as having an interest in his assets. So it is not an equity. So Babajide, you can go ahead. You want to say something?
Hello, sir.
Yes, Babajide.
So, I was actually waiting for you to give us an answer before I ask my question because I wanted to ask that on the flip side. So, what is it for we say Baba?
Oh, okay. Good thinking. So let's go in the direction that you expected. Let me tell you the answer first. So as I'm analyzing it, so I'm starting from equity. I said as far as Ade is concerned, Ade paid to Wese Baba, so it is not an equity to as far as Ade is concerned. So let's leave that. Also, secondly, some people said expense. So an expense is a decrease in assets. Expense is a decrease in assets. So as far as we are concerned, Ade asset has decreased. His cash has decreased. So I will say yes, it's an expense because his asset has decreased. Is it an asset to Ade? No, it is not an asset because an asset is an economic resource. Okay. Is that payment to Ade Baba an economic resource? No, it's not an economic resource to Ade. Of course, it's not a liability, it's not an income. So the answer, those that said expense were actually correct. But their thinking was that there was an outflow. I mean, based on the definition I gave you, don't think in the direction of there was an outflow. Think in the direction of decrease in assets, increase in liability, decrease in equity. That is an expense. So in this case now, there is a decrease in the assets, of a day, and that makes it an expense. Now, on the flip side, Wese Baba, it will be an income to Wese Baba. So Wese Baba asset has increased. Somebody gave him a gift. Somebody is like somebody giving you a grant, right? It's an income to you. Okay, it's an income to Wese Baba, right? So that's the answer here. So what if I'm already, I want to move to another direction again. What if Ade, instead of just giving this guy on the condition of priority statement, what if this 10,000 was to buy shares? If he gave Ade 10,000 to buy shares in the company of Ade, that I will be a shareholder in your company. So as far as Ade is concerned, what element of financial statement would that 10,000 then be?
Equity.
Any other person? She said equity. Other trials?
Assets. Assets.
Yeah, that's
Right.
correct. The answer is assets.
Invested. I'm getting confused.
Yes.
Or he
Yes, now.
bought.
Whether he invested or he bought.
Like so he's a
Whatever.
shareholder now. Was say Baba now.
Yes, now. So
Huh.
when you buy shares in, let's say, MTN, or you buy
Okay, yes,
shares
for him. Yes.
uh,
Okay, then for Wasa Baba it to be an equity, right? Or
yes,
what?
correct.
Because I'm getting
Yes.
confused. Okay. Okay.
Yes. Yeah. So we are still going to learn those ones when we get to financial instruments. But Ade is for Ade to be an asset, for we say Baba is equity. Okay.
Okay.
But for this particular question now, for Ade is an expense. For we say Baba, it will be an income. So question 4, Truthful Limited provides a warranty with every car sold. What element of financial statement is the warranty?
Liability.
That's correct. Liability. That's a liability because there is an obligation to transfer economic resources. There's a present obligation in which they have no practical ability to avoid. That's a liability. Good, you guys are following. Keep that up. So, chapter 5. This talks about the principles of recognition and derecognition. Recognition is the process of capturing for inclusion in the financial statement. So recognition is just like a more technical word for recording. So is process of capturing for inclusion in the statement of financial position and statement of profit or loss, an item that meets the definition of any one of the elements of financial statement. So immediately a transaction or an item meets the definition we explained in chapter 4, then the process of capturing it in the relevant statement is what we call recognition. Okay. So you also recognize when that item will be a faithful representation, when it will be relevant first. You need to be sure that that item you are recognizing is, if it's not going to be relevant, don't recognize it. And it must be a faithful representation. So ICAN can ask you in the exam, what are the criteria for recognition? Number 1 is that the item must meet the definition of the elements of financial statements. Number 2 is that the item must be relevant and must be faithfully represented, must be a faithful representation of the transaction. If it doesn't meet those 2 criteria, then you cannot recognize it. You cannot include it. On the flip side of recognition is derecognition, which is the removal of all or part of an item, whether it's asset or liability. So when you remove it, Then, and of course, you remove it when the item no longer meets the definition of an asset. You remove it. That's derecognition, right? So you will be using this term all through our study in this class. Recognition criteria, derecognition. These are the principles backing them up. That the major principle why you would derecognize an item is when the item no longer meets the definition. For example, I broke it down where there is a loss of control of an asset. Before you can have an asset, of course, you have an economic resources that is controlled, if you remember the definition. So when you lose control, then derecognize it. You have to derecognize it. Or when you no longer have an obligation for a liability, you don't have the obligation anymore. So these are core principles that you need to be familiar with as far as reporting is concerned. So derecognition and recognition. Then chapter 6 talks about measurements. So we have talked about elements are recognized when they meet the definition of elements, right? But you see, when they are recognized at a monetary amount. So the monetary amount in which they are recognized is what we call measurement. And in reporting, this requires selection of a measurement basis. So we have something we call measurement basis. When you want to recognize items in the financial statement, you must know what is the measurement basis. And we have two measurement bases in reporting. Two. It's not more than those two. Number one, historical costs. Number two is current value. I can assure you, every item in your report is either measured at historical cost or current value. It's not outside of these two. It's not. And historical cost for an asset is the price you paid for the asset. For a liability is the amount or the event that gave rise to the liability, how much you collected. And what we call historical cost, if your measurement basis is historical cost, believe me, the price doesn't change. That's the ideology for historical cost. The price will not change in the sense that that basis, that amount will continue to be the amount all through the period you recognize it in your books. The price does not change. Historical cost. And we are going to mention a lot about this as we move on. In almost every standard I will teach you. Historical cost. A better measurement basis is current value. This is better is because this one changes. Yes, it's the price you pay for an asset or a liability that will be updated to reflect any changes since it was acquired or incurred. So the difference between historical cost and current value is the fact that current value current value is like an historical cost that is updated to today's value. And according to the conceptual framework, there are three bases of current value. Because when we say something is updated, you need to ask the question, why are you updating it? Abi, it's situations that will warrant updates. So number one, if the reason you are updating is that you want to sell the asset, so you want to know what's the selling price today, so you need to update the value of your assets, then we are going to be talking about fair value. Fair value. So this is when you want to sell. That's when fair value is obtainable. Another one is value in use. This one is when you are still using the asset. You just want to know the value of the assets. You are still using it. So you just want to know that, okay, all through the period I will use these assets, how much do I stand to gain from this asset? All through the period I will use this asset. That is value in use. That's when you use value in use. And when you intend to replace an asset, when you want to get another one, so there's current costs, which you also call replacement costs. That's if you intend to replace an asset. So all of these are current value, and we're going to meet most of them as we continue to learn financial reporting. So these are the measurement bases in reporting. Then chapter 7. Oh, there are some questions here. Okay. This one says that in accordance with ISB's, the Conceptual Framework for Financial Reporting, which of the following is not a measurement basis?
Present value.
Present value.
That's correct. Which of the following criticism does not apply to historical costs? Does not apply during a period of rising prices. They are difficult to verify. The answer is A. Historical costs are very easy to verify because they don't change. So it does not apply to all of these apply to historical costs because historical costs contain mix of values. It depends on when you buy it. If the one you buy today, the cost today is the historical cost. The one you buy last year, that's the cost or amount you bought it that last year is the historical cost. So you'll find out that historical costs will contain mixture of value, and historical costs would understate your assets, especially in a period of inflation. You see, the price does not change. The price you bought it is the price at which you keep it in your books. Even when prices are going up, you still keep it at that price. That's historical cost. It doesn't change. So this one apply, and it also overstates. It will overstate your gearing. When it understates your asset, it definitely overstates your gearing. All of this will make sense as we move on. So A is the answer to this one. That they are difficult to verify. No, historical cost is so easy to verify because they don't change. It's the price you bought it. It's there. The receipt is there. So chapter 7, this one is also a very short one. So this is talking about presentation and disclosure. Okay. All of these elements that you recognize, that you measure, what chapter 7 is talking about is one, they are presented, especially the income and expenses, present them in your statement of profit or loss. However, there are some income that you would have to present in a statement called other comprehensive income. And these are income that are arising from a change in value. You will learn these things better. For now, this is just giving us a guide, which we apply later. So I'm just focusing on the core thing here. The core thing in chapter 7 is saying income expenses, put them in P&L. However, there are some income that you would have to put in a statement called other comprehensive income. I mean, if we believe that would faithfully represent that item, if it's arising from a change in value of an asset. So you will learn this. I will teach you this under IS 16, IS 38, and these other standards. So we call it revaluation of assets. So when you revalue your assets, that's a change in value of an asset. That surplus, we usually recognize it in other comprehensive income. And usually, the reason why most of these items goes to OCI is because we don't want to put that type of income in P&L because it might distort our profits. I mean, it's not like a real profit. It's like an unrealized gain. We revalued our assets. It's just like you had a Corolla now, and You bought it for like 2 million. Now it's worth 6 million. So in your books now, if you want to reflect that, it's like you have made a gain of 4 million. And that gain is an income. We will say don't put that gain in P&L because it's not like you have sold these assets. What happens if the dollar strengthens? The only reason why the value went up is because of the devaluation of our currency. What if it strengthens? What happens to that gain? It's gone. And you have gone to put that gain in P&L. You are showing that you have so much profit. So don't put such a gain in P&L. Put them in OCI. That's what this guy is saying. That when you look at it, put it in OCI, right? Then when you put it in OCI, it's possible for you to recycle it to P&L if it becomes end. So for example, now, if you now, before the value go down, you sold the asset, that 4 million, you now made it. You sold the asset for 6 million. And that gain now that is in OCI now, you can recycle it. Even though we don't recycle revaluation surplus to P&L, we recycle it directly to retained earnings. You will learn all of these things very well, but the ideology we want you to have at this level is the idea of that when you revalue assets, when you revalue liabilities, those changes in assets, those changes in liability, don't take it to P&L. Take them to OCI, okay? Because they are on end. They are on end. So when they become end, you can recycle them. That's the whole idea that we want you to keep here. And this, they also talks about some principles here. Can look at them. That we are still going to emphasize most of these things in IAS 1. That when you are presenting your statements, don't use a standardized approach. Avoid unnecessary details. And also don't offset like that. So those are principles of present. So this is not talking about how we present these elements in the appropriate statements. And finally is chapter 8. Chapter 8 talks about the concept of capital and capital maintenance. So there are two concepts of capital. Okay, so I'm speaking of concept of capital first, then I'll go to capital maintenance. So there are two concepts of capital. Number one, we have the financial concept of capital. We have the physical concept of capital. So the financial concept of capital, this sees capital as the money invested in the business or the net asset or equity of an entity. And it is this financial concept of capital that we use today to prepare our account. But what this conceptual framework is telling us is that that's not the only concept of capital we have. Because everybody uses financial concept of capital. There is another one called physical concept of capital, which is capital that is regarded as productive or operational capability of an entity that is based on unit of output per day. This one don't look at the amount invested, but looks at what the amount invested can produce. The productive capacity or operational capability of an entity. Now, considering this concept of capital, when have you maintained this capital? You see, you have maintained your capital when you make profits. When you make profits, then you have maintained your capital. If you are using a financial concept of capital, it's very easy. As soon as your capital at the end is more than your capital at the beginning, then you have maintained your capital. As soon as your capital at the end is more than your capital at the beginning, if you are using a financial concept of capital, then you have maintained your capital because that's profit. If you break even, you have also maintained it. That means they are the same. But for physical concept of capital, that one is not straightforward because that we don't just look at that your capital has gone up, but what we look at is the units that each capital can do. Okay, so you have maintained your capital from the physical concept of capital if the units your capital can produce at the end is higher than the unit you can produce at the beginning. So if you look at a company like this now, a company like this that can produce 100 units. So at the beginning, the value of that inventory is 500. But at the end, the value is now 600. Not like it has increased the unit it can produce. The only reason why this value is going up is inflation. Is because at the beginning, it was 5 naira per unit. Now at the end, is now 6 naira per unit. So it's still 100. So this guy has not really made profit because other assets are still the same. Other net assets are the same. So if you look at this capital, 500 plus 15, this is 15, 500 plus 1,000. At the end, 600 plus 1,000 is 16. The financial concept of capital will say this guy is making a profit of 100 naira. But the physical will say that, no, he's not making any profit. His productive capacity hasn't changed. It's just inflation that is making this one increase to 600. It's still 100 naira at the beginning and at the end. I said 100 naira, 100 unit at the beginning, at the end. The only reason why this is 600 is because the prices have gone up. So physical capital maintenance focuses on the unit that can be produced. And that is the concept of capital and capital maintenance. It's been a while I can ask questions on any of this. Most of their questions have been chapter 1, chapter 2, and I've told you. And there's no reason why they can't ask you questions on any of these items. So I can have been asking questions on this area of the syllabus. So you can go through these past questions in your handout. And you'll see that we have taken care of most of the items there. And there are some more advanced questions that I have here that are not ICAN past questions, but the solutions are there for you to practice with. If you have any challenges with any of them, do let me know. So we have come to the end of today's class. Do we have any questions before we say goodbye?
Okay.
Yes, I have a question.
Okay, let's take it one after the other. Who's
Yes.
going first?
Okay, let me go first.
All right. Yes, sir.
So, like the two concept of capital you have just explained, among the two, which one is recommended by practitioners? That is financial concept and physical capital.
So the one we use right now is the financial concept of capital. That's the standard practice. That's one everybody uses. So financial concept of capital is a practice today. So everybody just continue to use that.
Yes, I noted. Thank you.
Yeah. Any other questions?
So sir, this material, this one you use in doing this visual class now, are you sharing it as well?
I've shared it already.
To where?
Is to the group. Somebody can re-forward it to her. I forwarded all this to you. All of these notes to you.
Because it seems this especially that that chapter 2 is more detailed than the diagram you gave in the class.
Yes. It's in the notes. If you check the notes, you'll see it there.
Okay.
This one is note, so I will have explained everything I was saying with mouth in class in the notes, just so that the note will reflect everything I was saying. Using the note, if you check the note and it's different, you can let me know then. But I'm sure it's the same.
Okay.
Yeah. All right, guys. So let's go and sleep. We'll see next week. So bye.